would appreciate this, but we could just go into wedges real quick. What's a wedge, man? What's a wedge? Just for fun, because a lot of people know this already, and it's probably just redundant information for most people, but hey, some people might learn something. What's a wedge? For instance, let's go the following way. No, let's do a rising wedge, right? Let's do a rising wedge. Why not? Because we've done the falling wedge before. We can do it again later. So a wedge. What's a wedge, man? It is upsloping, right? You have two trend lines that converge and they're upsloping. A rising wedge. All right, let's just go ahead and be cool, man. Let's be real cool here. All right, there's your rising wedge. Oh my God, everyone in here knows about the rising wedge. Everyone's so cool. Everyone knows everything, but at one point you didn't know, right? So we have a nice move up, and this is going to be a rising wedge reversal, okay? Where you have a nice impulse up. And all of a sudden, the volatility picks up. The swing highs and the swing lows start becoming crazier, right? But then, after those big swing lows and big swing highs happened, you start getting that price contraction, right, that you had before where there's very little volatility. It was just going straight up, straight down, right? And so what's the criteria of the rising wedge? What makes a valid rising wedge? Where you got to have 5 touch points, right? So 1 touch point, 2 touch points, 3, 4, 5 touch points, 6 touch points is in this case, right? So what that just means is we've got exhaustion going on, right? We talk about all the time the price action you need to have, impulse up, down slope with your consolidation 50% of the way, and then run again and do it again and do it again, right? But with the wedges are inverse of that, right? The wedges are impulse up, and then you continue upsloping. So impulse up, upsloping consolidation. No one has the opportunity to accumulate. No one has the opportunity to cover a short where they screwed up. No one has the opportunity to do anything. So they sit there and wait. And then, so normally when impulse up and then you upsloping consolidation, you get exhausted because no one has the opportunity to get good value at certain Fibonacci levels, right? Like down here, right? The impulse up and then the upsloping consolidation. You know, you don't get down to 50%. You don't get on the 618. So no one gets the opportunity to get value. They don't see value in it unless it goes to those levels. When it gets to those levels in an uptrend, they might buy in and accumulate there, and therefore you don't have a wedge. But in this case, you don't even hit maybe at the 236 fib node, not even maybe. You just keep crapping around like that, and then eventually huge sell-off, right? Because guess what will happen in this situation? You get all kinds of bearish divergence that occurs really bad, okay, when you don't get nice moves down. Anyway, so what will happen in these rising wedges? You eventually will break a higher chance of breaking to the downside. Okay, and how do we measure? How do we play these? How do you trade these rising wedges? They are great for shorts. Make sure you have a rising wedge in a bearish market. That's the best way to trade any kind of pattern, is trade it with its trend. If it's a bearish pattern, the best results you'll get shorting are in bear markets. Okay, so where's the best area? Best areas to short these wedges are up here. At the top of the wedges, not the bottom. Always the best areas to short. Okay, and it could look something like this. But then, you know, and you just have a tight stop, as tight as you want, and maybe a little bit higher, whatever the risk is good, risk reward. But then you're like, wait, where's the, how do we know where to go? How do we know the target of these wedges? So you say, okay, very easy. From the widest areas of the wedge, the lowest low to the highest high at the beginning of the wedge, right? 556, whatever that is, it's for sake of. Okay, so it's very simple, right? That is your target. And so your reward to risk situation, you have 4.6 to 1 reward to risk. And the reason is look what happens when you go short at the top instead of the bottom. You get more reward and less risk, right? Does that make sense? More reward, less risk. Rising wedge reversal, okay, because there's the rising wedge continuation. And the rising wedge continuation is just where you're in a downtrend, right? Right. The downtrend is where impulse down, up, sloping consolidation. What we're seeing right? What we're seeing is the up here for Bradford's wedge, right? Whatever. That was the impulse down in the upsloping consolidation, which I don't think it was. I don't think that was it, man. I don't think that was it at all, obviously. Okay, so I don't know if the market was interpreting the wedge or the wedge on Ripple either. Ripple, just the channels look like they're playing the best as the market interpretation for now. Okay. So anyway, sweet. Both bearish patterns. One will want to play them in the bearish markets. These are not as reliable in bullish trends. Okay, kind of higher failure rate. And guess what? Like Apple, extremely bullish conditions. It actually, believe it or not, broke to the upside and hit target before dumping tremendously. Oh my God, dude. So if you were to break out, you can expect targets to the upside. Oops, oh my God, what just happened? No. Oh, am I hitting the wrong thing? What the heck, man? Okay, sweet. So if we broke to the upside, you could expect targets up here. And that's why having a stop is important, because then you don't get wrecked, right? So measured moves happen on both sides, no matter what kind of pattern, okay?